Hey, what's going on? This is Leo. Sorry about my absence the last couple of days. Kind of had a spur of the moment trip. It's the Florida mini lobster season here, so we went out and did some scuba diving for a couple of days to see if we can get some lobsters. We ended up getting four pretty decent sized ones, so have to put those on the grill later on today once we get them cleaned up. But let's go ahead and dive in here. So, recession. We're officially in a recession. We've had two consecutive quarters of declining GDP growth, which has been the kind of the staple of, okay, once we have those two periods, those two quarters of declining growth, we are officially in a recession type of thing. Now, the average length of a recession post World War II has been 11 months. So two quarters would be 8 months. So if we're just in a regular recession, then we're very close to the end of it. So the worst of it would most likely be behind us at this point. Now, I do want to address the comments that Fed Chairman Powell said. He says, "I don't think the U.S. is currently in a recession." Now, where have we heard that before? Well, if you think back to where he kept talking about, oh no, the inflation is transitory. It's transitory. It's going to go away. It didn't go away. In fact, it got a lot worse. So what I've noticed about Powell is that he likes to use this soft language. You know, he likes to kind of massage the public, and it's almost like he's lying to you. No, everything's fine. You know, there isn't going to be a recession. No. Inflation's going to go away in a month or two. No, it's not because we've printed trillions upon trillions of dollars and devalued our currency. No, it's not because it has nothing to do with traditional economics. And it's really laughable. But anyway, so my job here is to kind of try to dissect what they're saying and try to kind of unravel the truth for y'all. So that's what I'm trying to do here. But his reasoning is that, well, if you look at the job market's doing fine. Well, I mean, yes, that may be true. Typically in recessions, the job market doesn't do very well, but you still have two periods of declining GDP growth. You have high inflation. So it's not as simple as, well, this sector of the economy is doing well, so we must be having a perfect, we can't be in a recession because the job market's strong. And it makes me think back to a quote from one of my favorite traders, Jesse Livermore. He says that opinions are often wrong, but the market never is. So it's his opinion. And this goes for me too. You know, I'm not the all-knowing authority on the economy. I know a thing or two, but he's giving his opinion. He's deviating from the typical rules and laws of economics and saying, well, I don't think those apply anymore because of this reason. That's an opinion, not really based on fact. So I strongly disagree, especially with how he handled inflation as far as, no, it's transitory. And then he just sat there and didn't do anything until it was too late and it was far out of control. So no, I don't trust Federal Chair Powell at all. And to top that off, we are in, if you don't count the couple month recession during the COVID pandemic, we're in the longest period of economic growth in U.S. history without a recession. So you have the signs lining up of two quarters of slowed economic growth in the longest period in U.S. economic history with us not having a recession. Most likely it's a recession. Everything's pointing that it's a recession. But Powell's saying, it can't be a recession. The job market's strong. It's kind of laughable. But again, he's using that soft language to try to massage the public so they don't get super panicky and upset and whatnot. And anyway, so let's look at the option two. That let's say because I personally think that it's not just a recession. I think that we're moving into a period similar to the 1970s and early 80s of stagflation. Now, stagflation is a period of high inflation and slow economic growth. So if we come over here to the chart, we can take a look at that. So, whoops, didn't mean to move that. So here's what I'm talking about. It was this period where the stock market essentially just moved sideways, right? And what causes stagflation? Well, whenever you have runaway inflation, the proper thing to do, or the more drastic approach, is to drastically raise interest rates to reduce the amount of money within the economy, because the Fed's monetary policy is what that determines what happens with the economy. How cheap money is, well, how cheap credit is, affects economic growth. So whenever you have inflation running out of control, what they want to do is they want to reduce the money supply, and they do that by making credit, meaning borrowing money, more expensive. So what if you can't take that approach because the economy has gone too far too quick, and you're in a situation if you raise interest rates too high that the economy will just crash, and you don't want that to happen. So it's sort of a middle ground where you moderately raise interest rates to try to stop inflation from increasing, but not necessarily bringing it back down to where it should be. And it's almost like a wait out period. So you have slow economic growth. It's almost like the Fed is choking the economy, but it's not enough to kill it. It's just restricting its airflow. And so you have this period of slow growth. So if we come over here and look at the historical inflation rates, what I want to point out is that starting in 1973, you can see inflation was around 3.6, kind of moved up to 5, and then it just slowly ticked up from there. And then in 74, it got up to 12, and then it started moving back down again to 7. So, but that wasn't the end of this period of stagflation. You had it ups and downs with the inflation, right? So, I mean, in the beginning, it started around 5, it got all the way up to 12, then it went down to 5 again, and then you had a couple of years where it was somewhere between 5 and 8, and then it moved up to got all the way as high as 15 in 1980. So even if the Fed manages to get inflation to come down slightly, it doesn't necessarily mean it's over, right? Inflation would need to come back down to like 3% and stay there for a long time in order for this period of what I'm considering to be stagflation to be over. So what I would expect to happen here is the second that a report comes out saying that inflation dropped a little bit, oh, it's over, we've won. And it's, it's not that simple. It takes time to know whether you've accomplished what you've wanted to accomplish with beating inflation. So I think that this is the better option than having a massive collapse in the economy, going into some sort of a depression. This is more of just slow economic sideways growth. I think that's a better option than moving into another depression or something like that. So anyway, so this period lasted roughly a little less than 10 years. Now, it doesn't mean that this period that we're in currently would need to last that long, but it certainly could. So, it could get stretched out. So if we come over here, what we can do is we can take a bars pattern just to kind of get an idea of what could the period that we're currently in look like based on what has happened in the past. So we take a little screenshot of these bar patterns and we move them over to here. So this is what we'd be looking like for our economic growth. So if we come down here, kind of just come back up to the highs and just grind sideways for a while, and then eventually we kind of break out to a new high, it's not that bad, right? You're not going to see these drastic returns that we've been seeing in the stock market, at least since 2009 up. But, that's typically what happens within the economy. You have these impulsive moves, right? So here would be an impulsive move. And so whenever the market moves too quickly, too fast, what ends up happening is you have sideways action, right? It's because you need the value of those companies that become overinflated to catch up to where the price is. And so if there's not a big scare to force prices down, you end up with this sideways movement. So you see that here. You see it post Post World War II, you see this massive move in the economy, and then it moves sideways, and then you see another rip, move sideways, massive rip, and move sideways. Or at least that's what I believe is going to be happening. So I think that pretty much wraps up this video. If you find the content valuable, please subscribe, and I'll talk to y'all soon.